Well, we've talked about leverage. We've talked about financial leverage in terms of our debt to equity ratio or assets to equity ratio and things like this. So we're going to refine this a little bit and also talk about operating leverage and actually calculate some measures of leverage in this reading here. So let's define these, what we're going to be talking about here. Leverage, more generally, is the effect of fixed elements in the cost structure. Now, these could be fixed operating expenses, in which we say they're leading to operating leverage, and financial leverage if we have fixed financing costs. So if we have debt outstanding where we have to make mandatory interest payments each period, then we've introduced some financial leverage. When we use the term business risk, we're really talking about the variability in EBIT, earnings before interest and taxes, or we often use that as our proxy for what we call operating earnings. And this is affected by operating leverage, the fixed costs in our cost structure. And financial risk, that's going to be the variability in earnings per share a little further down the income statement, right, from their fixed interest costs of debt financing. Now, that EBIT is before interest costs, and earnings per share is after we put the costs of financing into our income statement. So our measure of the degree of operating leverage, let's look first at the interpretation of it. It's the percentage change in operating earnings to the change in sales. So we're saying if there's a 1% change in sales, so top line of the income statement, right, a 1% change in sales, how does that affect our EBIT further on down? Well, this is what's going to depend on the fixed costs in our operations. Now, to calculate it, our degree of operating leverage, our numerator is sales minus total variable costs, and our denominator, sales minus total variable costs plus our fixed costs. So the variable costs might be the cost per unit of your raw materials and the work, the labor that goes into manufacturing your product. And your fixed costs may be the cost of the building, the factory, things like this that are directly related to production, but those are costs that don't change when we change the volume a little bit. And notice that because we've got sales in here, both of these items are affected by what level of sales or revenue we are. So we'll get a different degree of operating leverage at different sales levels for the same firm and for the same structure. And one way to help you remember this formula for calculating degree of operating leverage is that you see where fixed costs is in there. If fixed cost is 0, then we've got sales minus total variable costs over sales minus total variable costs. We would have a degree of operating leverage of 1, which is no leverage, a 1-to-1 relationship. 1% change in sales, 1% change in operating earnings. So it's the introduction of fixed costs that gives us operating leverage. So let's just crunch these numbers once to see how this works. Firm produced 5,000 units last year, so we'll figure 5,000 units. Fixed costs are $70,000, the selling price was $75,000, and variable cost per unit was $50 per unit. And we're asked to calculate the firm's degree of operating leverage at 5,000 units. Well, for our numerator, we want sales minus total variable costs. Well, here we've got the price per unit, and we were given variable cost per unit. So $25 of that sales price goes to offset fixed costs, sometimes called the contribution margin, and then we just multiply that times the total number of units sold. And that goes in the numerator and then again here in the denominator, and then we just subtract off the fixed costs there. And we get a degree of operating leverage of 2.27. So we've got some leverage there, and we would interpret that is at a sales level of 5,000 units, a 1% change in sales is going to lead to a 2.27% change in EBIT. our operating earnings. And we'll go through a similar exercise with financial leverage here. First, now remember, with financial leverage, we're getting further down the income statement, so now our interpretation of the financial leverage, or I should say of our degree of financial leverage, is the ratio of the percentage change in earnings per share to the change in operating earnings. So the ratio of this variability of earnings per share, how much is it magnified by having fixed costs, fixed financing costs. And again, you can see from the formula here, the calculation, that if we have no debt with no fixed interest payments, then there's no financial leverage, and DFL would be one. But when we introduce fixed financing costs, then that reduces the denominator and increases our degree of financial leverage above 1. So let's look at a numerical example of that. Firm's got operating earnings of $55,000 and interest expense of $20,000. If EBIT increases by 3%, what will be the effect on earnings per share? Well, now we can just directly plug these in. We've got our operating earnings here and here. We've got our fixed financing costs here. We get degree of financial leverage of 1.57, and our interpretation is that every increase of 1% in operating earnings is going to increase earnings per share by 1.57%. So here we've got an increase in the question of 3%. So if we multiply that 3% by 1.57, our degree of financial leverage, we see the change in earnings per share would be an increase of 4.71%. And we can take these two together and come up with the degree of total leverage. So the total degree of total leverage, our denominator is the same one we had for the degree of operating leverage, but our numerator is the one from the degree of financial leverage. So this is jumping us from sales to earnings per share. And it's really just the product of operating leverage and financial leverage. So our degree of total leverage is simply the product of the degree of operating leverage and the degree of financial leverage. And our calculation, well, we've got the numerator that we used for DOL, and we've got the denominator that we used for DFL. And that's all there is to it. So we've got sales minus total variable cost over sales minus total variable cost, and then minus our fixed costs in our cost structure and our fixed interest payments. So as an example, consider last year's sales of $375,000, total variable costs of $250,000, fixed costs of $70,000, and interest expense of $20,000. Well, the calculation's quite straightforward. In our numerator, we're going to have sales minus total variable costs, and in our denominator, sales minus total variable costs, minus our fixed operating cost, minus our fixed financing cost, and we get a degree of total leverage, the ratio of the change in earnings per share to the change in sales of 3.57. And since we used the same numbers here, we could have gotten to the same place by just multiplying our DOL, we calculated as 2.27, times our degree of financial leverage, we calculated as 1.57, and that gets us to our degree of total leverage. So some rules about leverage. Hey, high fixed costs, high operating leverage. Sounds reasonable to me from what we've seen. High debt ratio, high financial leverage. And high fixed cost plus high debt ratio gives us high total leverage. And so sometimes we see companies that have low operating leverage tend to take on more financial leverage than firms that have high operating leverage. They don't take on as much financial leverage to keep their total leverage in I guess, within a range that we'll say they're comfortable with. Well, let's take a look at our financial leverage here through an example. So we start out with no financial leverage. And we see that with the numbers given here, no interest expense, we follow these down, 32 in taxes, that gets us to 48 of net income. Here's our shareholders' equity, so here is our return on equity right here. Well, now let's tweak that a little bit. And what we're going to do is we're going to take that EBIT up 10% and down 10% and see what that does to our ROE. Well, because we have some effects of that, we see that our ROE goes up if our earnings before interest and taxes goes up, and goes down if our operating earnings fall, as we would expect, because we're holding our shareholders' equity, the denominator of our ROE, we're holding that constant and fooling with the numerator, net income. Now let's add some financial leverage to that, 50% financial leverage. So now you can see our shareholders' equity, we've reduced that because the other half of our assets is financed with debt. And we get an ROE that's higher. Okay? So financial leverage can increase your ROE, but it also increases the sensitivity to these changes, because now we've got this overlay of financial leverage here. And so you can follow those numbers through. I assure you they work. But let's look at ROE now. Now, with financial leverage, an increase in operating earnings at 10% is increasing that ROE from 15.6 to 17.52, and a decrease in operating earnings would decrease that ROE like that. So we can see some of the effects of adding some financial leverage here. Our next topic we need to cover is this break-even quantity of sales, and this is very straightforward, especially since if you've already been through the financial reporting and analysis, we're just basically going down an income statement to find the break-even quantity. So we're going to define that as the quantity at which the firm's net income is zero. And we can calculate that as total fixed costs over price minus variable costs per unit. Remember, we had that earlier example where we had variable cost per unit of 50 and a price of 75, and I mentioned that $25 difference. Each time they sell one unit, that $25 difference of the price above variable costs can go to cover fixed costs. So all this equation is giving us here is, well, how many units do you have to sell to cover your whole fixed costs? So looking at a new example with a price of 4 and variable cost per unit of 3 and fixed costs of 40,000, what is the firm's break-even quantity of sales? Well, before we even look at that, just think about it for a minute and say, well, every time we sell one, our variable costs take $3 of that. We have $1 left over to cover fixed costs. Well, at $1 a unit, how many units do you have to sell to cover $40,000 of fixed costs? Well, that's no puzzle right there. It's 40,000 units. So there's our break-even quantity. We take what we call that contribution margin, price minus variable cost per unit, and just divide that into total fixed costs. How many units do we have to sell to just cover our fixed costs? So that's why it's break-even. We've just covered our fixed costs, and we've covered our variable costs. So we're break-even. We have another one that asks, another LOS here that asks us to calculate net income at various sales level. But again, having been through the accounting material, this is pretty basic for us. Assume the following for a firm. We've got price, variable costs. Fixed costs are now $10,000, fixed operating costs, and interest expense is $30,000. We're going to ignore taxes in our calculation here. What's the firm's net income at sales levels of 55,000 units and 35,000 units? Well, we just can construct a little income statement that says, well, take the quantity times price minus variable costs. That's what we've generated above variable costs. Then subtract the fixed costs and subtract the interest, and anything that's left over is our net income. So just like going down a simplified balance sheet. And there it is, $55,000 we've generated on our sales above total variable costs. We subtract 10 and 30 from that, end up with $15,000, and that's our net income at a sales level of 55,000 units. And at 35,000 units, you can see it's minus 5,000 there. We didn't cover our total fixed costs and fixed operating costs and fixed financing costs. So this leverage, remember, it gives more sensitivity to net income. So a change in sales has a greater effect on net income because of our operating and our financial leverage. Now, just another definition here, we're going to say operating break-even quantity is a level of sales that just covers the firm's fixed operating costs. Same drill as we went through before, but now we're just going to ignore the financing costs and say, well, if we want the level of sales at which EBIT, operating earnings, is 0. So for that, we've got fixed costs, 80,000. Okay. So if we've got fixed operating costs of 80,000, how many units do we have to sell to cover that? Well, our contribution margin here is 4 minus 2 on each unit. So we divide 80,000 by 2 and say, well, if we produce 40,000 units, we'll be operating break even. Now, notice we've ignored the financing costs. So we're not talking about break even for as in net income equals 0. If we had financing costs, interest costs, our net income is going to be negative here. We were operating break even.